How your credit score is destroying your money. Fix this now and achieve financial freedom. There is a three-digit number sitting quietly in a database somewhere, and it decides how much you pay for almost everything in your life, whether you know it exists or not. It decides the interest rate on your loan. It decides your insurance premium. It decides whether a landlord hands you the keys to an apartment or asks for a cosigner instead. It can decide whether a company even calls you back for a job. This number is invisible in your daily life, yet it works against you every single day, quietly taxing your income while you have no idea why things cost more than they should. This is not an exaggeration. This is the modern financial system, functioning exactly as it was built to function. And the worst part is that most people only discover the power of this number after the damage is already done, when the loan comes back with a brutal interest rate, when the card gets declined, when the rental application requires a guarantor because a number told a bad story about them before they even opened their mouth. Imagine two friends applying for the exact same car loan on the exact same day, at the exact same dealership, for the exact same vehicle, and walking away with payments that differ by $100 a month, for years, simply because of a number neither of them fully understood. Most people spend more time researching which streaming service to subscribe to than they ever spend understanding the single number quietly shaping nearly every major financial decision of their adult life. And that imbalance alone explains why so many otherwise smart, capable people remain stuck paying more than they should for everything they finance. Over the next half hour, you are going to understand exactly how this number works, why it is sabotaging your money right now, and precisely what to do, step by step, to flip it in your favor and walk, for real, toward financial freedom. The first thing to understand is what this number actually represents. Your credit score does not measure how much money you have. It measures how much lenders trust you to repay what you owe on time without drama. It is a confidence rating, calculated from your past behavior, used to predict your future behavior. This means two people earning the exact same income can carry completely different scores because the score never asks how much you make. It asks how you behave with what you already owe. That detail changes everything because it means the score is not about wealth, it is about documented discipline. And documented is the right word because every late payment, every bill paid on time, every credit limit pushed to its edge gets recorded, building a history that speaks for you before any conversation ever happens. Two neighbors can drive similar cars, live in similar homes, and still pay wildly different amounts for the exact same loan, purely because one of them has spent years quietly proving reliability while the other never realized anyone was even watching. A doctor earning an excellent salary can carry a mediocre score, while someone earning far less but paying every bill without fail can carry a score the doctor would envy because the number was never designed to measure success, only consistency. If this number is this important, why did almost nobody explain it to you properly? The answer is simple and uncomfortable. There is no commercial incentive for banks to teach you how to build a high score quickly. Banks, lenders, and store credit programs profit precisely in the gray zone where you do not fully understand the rules but keep using credit anyway. Schools do not teach this. Parents who never learned it themselves cannot teach it either. So generation after generation, people learn about credit scores the hard way, usually after a rejection, after a painful interest rate, after watching a dream purchase slip away because a number told a story nobody bothered to explain in advance. The system was never designed to be hidden out of malice. It simply was never anyone's job to make it clear, and silence, left unchallenged, tends to benefit whoever already holds the advantage. Every year, this knowledge stays undertaught. An entire new generation of adults enters the financial system blind, repeating the exact same expensive mistakes their parents made, simply because nobody along the way ever sat them down and explained the rules of a game they were already required to play. To actually control this number, you need to understand what it is built from, because it is not one single measurement, it is 5 combined factors, weighted differently, working together like ingredients in a recipe. Payment history carries the heaviest weight, because lenders care more than anything about whether you pay on time. Credit utilization comes next, measuring how much of your available credit you are actually using at any given moment. The length of your credit history matters too, rewarding accounts that have existed for years over accounts opened last month. Credit mix plays a role, reflecting whether you can responsibly manage different types of debt. And new credit inquiries factor in as well, penalizing you slightly every time you apply for something new. Understanding these 5 ingredients is the difference between guessing blindly and making deliberate, calculated moves that push the number exactly where you want it to go. Most people treat their score like weather, something that simply happens to them, when in reality it responds predictably to specific, controllable inputs, the same way a recipe responds predictably to the ingredients poured into it. Payment history deserves special attention, because a single missed payment can undo months, sometimes years, of careful progress. This is the part most people underestimate the most. One late payment, reported to the bureaus, can sit on your record for years, dragging your score down every single month it remains visible. The system is not designed to punish you once and move on. It is designed to remember. This is why a single moment of disorganization, one forgotten due date buried in an inbox, can cost you thousands of dollars in higher interest paid across every future loan you take out. The lesson here is brutally simple. Consistency matters more than perfection. A person who pays every bill on time for years, even small ones, builds a foundation that a single wealthy but disorganized person can never match, no matter how much money sits in their account. Setting an automatic minimum payment on every single account removes the human error entirely from the equation, turning a fragile habit into a guaranteed outcome that no bad week or forgotten notification can ever undo. Even a single missed payment on a tiny recurring subscription, one most people would never think twice about, can report to the bureaus exactly the same way a missed mortgage payment does. Because the system does not measure the size of the debt, only whether you honored the agreement. Most bureaus also give a short grace window before a late payment actually gets reported, typically around 30 days past the due date, which means a payment made even a week late, while still uncomfortable, rarely leaves a permanent mark, as long as it never crosses that reporting threshold. Knowing that window exists removes unnecessary panic from an occasional slip, while still respecting how seriously the system treats anything that crosses fully into delinquent territory. Now consider credit utilization, one of the most misunderstood factors of all. This measures how much of your available credit limit you are actually using at any given moment. Many people assume using their full limit shows financial strength, proof that a bank trusts them enough to extend that much credit. The opposite is true. High utilization signals risk, suggesting dependence on borrowed money rather than comfortable financial breathing room. Lenders generally reward utilization kept well below a third of your total available credit. This means a person with a modest credit limit who uses very little of it can outscore someone with a much higher limit who maxes it out every month. The number is not about how much credit you have access to. It is about how much restraint you show while having access to it. A simple trick many people never think of is requesting a credit limit increase on an existing card without spending more, which instantly lowers your utilization percentage without changing a single habit. Timing also matters here, because utilization is often reported at the moment your statement closes, not the moment you pay, so paying down a balance a few days before the statement date can lower the reported number dramatically, even if the full balance eventually gets paid off anyway. This single timing adjustment costs nothing, requires no extra money, and yet can shift a score meaningfully within a single billing cycle, which makes it one of the highest return actions available to anyone actively watching their number in the weeks before a major loan application. Length of credit history is the factor almost nobody thinks about until it is too late, and it explains a mistake countless people make without realizing the damage. Closing an old credit card feels responsible, almost like decluttering, but it can quietly hurt your score in 2 separate ways. It shortens your average account age, which lenders use to judge stability, and it reduces your total available credit, which can spike your utilization percentage overnight, even if your spending never changed. An old account, even one rarely used, is quietly working in your favor every single month. It stays open simply by existing and proving a long, stable relationship with credit. This is why financial advisors so often recommend keeping old accounts open, using them occasionally, rather than closing them the moment they stop feeling useful. That first card you opened years ago, the one sitting forgotten in a drawer, may be doing more for your score right now than any strategy you could actively pursue today. A single small recurring charge, like a streaming subscription, paid automatically and in full every month, is often enough to keep an old account active and contributing positively for decades without any real effort at all. Every time you apply for new credit, whether a card, a loan, or even certain financing offers at checkout, a hard inquiry gets logged onto your report. Individually, one inquiry barely moves the needle, but several inquiries clustered together within a short period tell a very different story to lenders. One that reads as desperation, as someone suddenly hungry for credit, possibly because their finances are unstable. This is why applying for 5 store cards in a single shopping season, chasing small discounts, can quietly damage your score far more than the discounts were ever worth. The lesson is patience. Space out applications. Apply only when genuinely necessary, and understand that every application leaves a mark, even if that specific application gets approved. A single well-timed application, made when your finances are strong, will always outperform a scattered burst of applications made out of impulse or momentary temptation. There is an important exception worth knowing here, because rate shopping for a single major purchase, like a car or a home, within a short window is often treated as one inquiry rather than several, since the system recognizes comparison shopping as smart behavior rather than reckless borrowing. Credit mix adds another dimension entirely, rewarding people who can responsibly juggle different types of debt rather than relying on just one. A person with only credit cards looks different to a lender than a person managing a credit card, an auto loan, and a small personal loan, all paid responsibly. This does not mean you should go acquire debt you do not need simply to diversify your profile. It means that as your financial life naturally grows, handling different types of credit competently adds credibility, proving your discipline extends beyond a single type of borrowing. This factor carries the least individual weight of the 5, but it becomes the deciding difference between a good score and a truly excellent one, especially once the other 4 factors are already well managed. Someone in the early stages of building credit should never prioritize this factor over the first 2, because chasing diversity before mastering the basics is like decorating a house before the foundation has fully set. A young adult with a single well-managed credit card, paid in full every month for several years, will always outscore someone juggling 5 different accounts poorly, proving once again that this entire system rewards depth of discipline far more than breadth of activity. Here is where the abstract number becomes brutally real money. And this is the part that should genuinely upset you. The difference between a mediocre score and an excellent score is not a small inconvenience. It is tens of thousands of dollars over the course of a lifetime. A mortgage, a car loan, even certain insurance premiums are all priced based on perceived risk, and perceived risk is measured almost entirely through this number. Someone with a poor score refinancing a home loan pays dramatically more in interest over 30 years than someone with an excellent score for the exact same amount borrowed. This is not a hypothetical example. This is happening right now, silently, to millions of people who assume their score is simply a background detail rather than one of the single biggest financial levers available to them. 2 people can borrow the identical sum from the identical bank on the identical day and walk away owing amounts that differ by a small fortune purely because of 3 digits neither of them ever fully understood. Stretch that same gap across a 30-year mortgage, and the total difference in interest paid can rival the price of an entire second home, a staggering cost for something that could have been prevented with a few years of disciplined behavior. Car loans tell a similar story on a smaller scale, where a weaker score can add a meaningful amount to the total cost of every single vehicle purchased across an entire adult lifetime. An invisible tax paid quietly, one loan at a time, by anyone who never took the time to understand how the number worked. Beyond loans, this number follows you into places most people never expect. Insurance companies in many regions use credit-based scoring models to help determine your premiums, treating financial responsibility as a proxy for overall risk. Landlords routinely pull credit reports before approving rental applications, using this score to predict whether you will pay rent reliably. Some employers, particularly for roles involving financial responsibility, review credit history as part of the hiring process. This means a low score does not simply cost you money on loans. It can quietly close doors you never even knew were connected to this number in the first place, doors involving where you live and where you work. The number stopped being just a lending tool decades ago and quietly became a general reputation score for adult responsibility, whether that expansion was ever fair or not. A qualified candidate can lose a job opportunity entirely to a slightly less qualified one, simply because a background check surfaced a credit history that raised an unspoken red flag nobody ever explained to them directly. Even utility companies and cell phone providers sometimes check this number before waiving a security deposit, meaning a strong score can quietly save you money the very first week you move into a new home, long before a single loan or mortgage ever enters the picture. Understanding all of this naturally leads to one of the most dangerous traps hiding inside modern credit: the minimum payment. Credit card companies design minimum payments to feel manageable, almost painless, while the underlying balance barely moves. A relatively small balance, left on minimum payments alone, can take years to disappear, with the majority of every payment going toward interest rather than the actual debt. This is not an accident. It is one of the most profitable mechanisms in the entire lending industry, because it keeps a balance alive for as long as possible, generating interest for as long as possible. Escaping this trap requires paying more than the minimum whenever possible, understanding that the minimum payment was never designed to help you, it was designed to help the lender. A balance that feels almost invisible on a monthly statement can quietly cost more in total interest than the original item was ever worth, sometimes several times over, meaning a modest purchase can end up costing double or triple its original price by the time it is finally paid off. Run the math on any card statement and you will usually find a small line disclosing exactly how many years it would take to clear the balance at minimum payments alone, a number most people scroll past without ever reading, even though it quietly reveals one of the most expensive traps hiding inside an otherwise ordinary piece of plastic. There is a related trap that deserves its own moment of attention, and that is the balance transfer offer, the promotional 0% interest period that arrives disguised as a rescue. These offers can genuinely help someone escape high-interest debt, but only when used with a clear plan and a firm deadline. Too many people transfer a balance, feel instant relief from the lower payment, and then continue spending on the newly freed-up original card, effectively doubling their total debt by the time the promotional period ends and full interest resumes. The tool itself is neutral, neither good nor bad, but the behavior surrounding it determines whether it becomes a genuine escape route or simply a more elaborate version of the same trap wearing a friendlier disguise. Before moving toward solutions, it is worth clearing up the myths surrounding credit repair, because misinformation here costs people real money. Paying someone to erase accurate negative information is not credit repair. It is often fraud, and it rarely works the way it is advertised. Closing all your cards at once to start fresh does not help. It usually hurts, for exactly the reasons already covered regarding history length and utilization, and carrying a small balance on purpose, believing it somehow proves activity to lenders, is simply false and often costs unnecessary interest for zero benefit. Real credit repair is neither mysterious nor expensive. It is methodical, patient, and grounded entirely in behavior, not shortcuts. Anyone promising an instant fix for a fee is almost always selling false hope, dressed up in financial language designed to sound official, and the surest sign of a scam is any promise involving speed, since nothing about a legitimate score can be rushed past the natural pace of documented behavior. Legitimate credit repair starts with something almost nobody does: actually reading your own credit report line by line. Errors are far more common than most people assume: an account that is not yours, a payment marked late that was actually on time, an old debt that should have already fallen off the report entirely. Disputing these errors directly with the credit bureaus, in writing, with documentation, can produce fast, meaningful improvements, sometimes within a single reporting cycle. Beyond disputes, negotiating directly with creditors on old unpaid debts can sometimes result in updated reporting in exchange for payment. A strategy many people never realize is even possible, simply because nobody ever told them they were allowed to ask. Requesting your full report at least once a year and actually reading every single line remains one of the highest leverage financial habits almost nobody practices consistently, and it costs nothing but a small amount of time most people already waste elsewhere without a second thought. For anyone starting from zero or recovering from serious damage, the path forward is more accessible than most people believe. Secured credit cards, which require a small deposit that becomes your credit limit, allow you to build a positive payment history with virtually no risk to the lender, since your own money backs the line of credit. Credit builder loans work similarly, structured specifically to help establish a track record rather than provide immediate spending power. Becoming an authorized user on a family member's long-standing, well-managed account can also transfer some of that positive history onto your own report. None of these paths are fast, but all of them are reliable, and reliability, repeated consistently, is exactly what this entire number was designed to measure in the first place. Someone starting with no history at all can often reach a genuinely strong score within a couple of years, simply by following these steps without a single dramatic gesture along the way, proving that patience applied correctly beats almost any shortcut this industry tries to sell. Underneath every one of these strategies sits something deeply psychological, because credit behavior is rarely just about math. Many people overspend or fall behind not from lack of knowledge, but from using spending as emotional relief, a reward after a hard week, a distraction from stress, a quiet way of feeling in control when everything else feels uncertain. Recognizing this pattern matters just as much as understanding utilization ratios or payment history, because no strategy survives contact with an unexamined emotional trigger. The people who successfully rebuild their credit long-term are rarely the ones who simply memorized the rules. They are the ones who also learned to notice the feeling that leads to the swipe and chose, deliberately, to interrupt it, replacing the impulse with a pause long enough for logic to catch up with emotion. A person who understands their own emotional spending triggers holds more power over their score than a person who has merely memorized every rule this video has explained, because knowledge without self-awareness rarely survives a genuinely stressful month. A simple habit that helps enormously here is waiting a full day before any non-essential purchase above a small threshold, giving the initial emotional urge time to pass and allowing a calmer, more rational version of the same decision to take its place. Once the fundamentals are in place, most people ask the same question: how long does real improvement actually take? The honest answer disappoints people expecting a shortcut, but it also reassures anyone willing to stay consistent. Meaningful movement often begins within a few months of corrected behavior, as old negative marks start losing weight and new positive history begins accumulating in their place. Full recovery from serious damage, such as a past default or a long stretch of missed payments, typically unfolds over 1 to 2 years of disciplined, unremarkable behavior. There is no legitimate way to compress that timeline dramatically, and anyone claiming otherwise is almost certainly selling something. The number rewards patience specifically because patience is difficult, and difficulty is exactly what makes it a meaningful signal to lenders in the first place, since anything easily faked would stop being useful information almost immediately. A practical 90-day acceleration plan can move the needle faster than most people expect, without requiring any dramatic financial overhaul. In the first 30 days, pull your full credit report, dispute every error you find, and set every single bill to automatic minimum payment so nothing is ever late again by accident. In the next 30 days, focus entirely on utilization, paying down balances aggressively or requesting limit increases on accounts in good standing, driving that percentage down as low as realistically possible. In the final 30 days, resist all new credit applications entirely, letting the previous 2 months of improvement fully register and stabilize across your report. This is not a magic formula. It is simply the 5 factors applied in the correct order, with enough focused attention to produce a visible shift within a single financial quarter, often enough to noticeably improve loan offers received during that exact same window. Writing this plan down, with specific dates attached to each 30-day phase, transforms a vague intention into a concrete project, and concrete projects with deadlines get finished far more often than good intentions left floating without any structure around them at all. It also helps to understand that not every lender looks at the exact same version of this number. Different scoring models weigh the same 5 factors slightly differently, which is why you might see a modestly different number depending on which report a particular lender pulls. This is not a flaw in the system. It simply reflects different mathematical formulas built by different companies competing to predict the same underlying behavior. The practical lesson here is simple. Do not obsess over the exact figure shown on a single free app, and instead focus on the underlying behaviors that improve every version of the score simultaneously, since a person with excellent payment history and low utilization tends to score well across every model, regardless of the small mathematical differences between them. There is also a generational pattern worth naming honestly, because younger adults today face a genuinely different starting line than previous generations did. Rising costs of living, delayed home ownership, and heavier reliance on digital spending have changed how quickly a first-time borrower can establish meaningful history. This does not make the fundamentals any less true. It simply means starting earlier matters more than ever. A young adult who opens one modest credit card the moment they become eligible uses it sparingly and pays it off every single month, gains a multi-year head start that compounds in value for decades, the same way an early investment gains extra decades of growth simply by starting sooner rather than waiting for a moment that feels more convenient. Waiting until your late 20s or 30s to open that first account, out of caution or simple unawareness, means competing later in life against people who quietly started this clock a full decade earlier, an advantage that no amount of income can fully replace once that time has already passed. Once your score genuinely stabilizes at a strong level, an entirely new set of opportunities opens up that most people never think to pursue because they never expected to reach this point in the first place. A strong score becomes a genuine negotiating tool, allowing you to request lower interest rates on existing accounts simply by asking, since lenders would rather retain a reliable customer than lose them to a competitor. It becomes leverage for refinancing existing debt at dramatically better terms, freeing up monthly cash flow that can be redirected toward investing rather than interest payments. It becomes a foundation for eventually acquiring appreciating assets, property, a small business loan, opportunities that were simply never available to a lower score, regardless of how good the underlying business idea might have been. Relationships add a layer to this story that almost nobody discusses openly, because credit scores remain individual even inside a marriage or a shared household. Two partners do not merge into a single score simply by combining finances, but their financial decisions inevitably affect each other, especially once joint accounts, co-signed loans, or a shared mortgage enter the picture. A partner with a weaker score can quietly raise the interest rate on a joint loan for both people, even when the other partner has spent years building an excellent history alone. This is why an honest conversation about credit, uncomfortable as it may feel, belongs early in any serious relationship, long before a joint application forces the topic into the open under financial pressure. Couples who treat credit as a shared project, checking scores together, celebrating improvement together, tend to build stronger financial foundations than couples who treat it as a private, unspoken number each person quietly hides from the other. Protecting this number matters just as much as building it, and identity theft remains one of the fastest ways an otherwise excellent score can collapse without warning. A stranger opening a card in your name, running up a balance, and vanishing before the first payment comes due can devastate years of careful work within a matter of weeks. A credit freeze, which restricts new accounts from being opened in your name without your explicit permission, costs nothing and removes this entire risk almost completely. Regularly reviewing your report for unfamiliar accounts serves the same protective function as checking a bank statement for unauthorized charges, a small habit that catches damage early, before it has time to compound into something far harder to unwind. Anyone serious about protecting a hard-earned score treats this kind of monitoring as a permanent habit, not a one-time task completed and forgotten. Most bureaus now offer free alerts the moment any new account gets opened in your name, turning what once required constant manual checking into a passive safeguard running quietly in the background, catching fraud within days rather than the months it once took people to notice by accident. Ultimately, the goal was never simply to chase a higher number for its own sake. The real goal is what that number unlocks: lower interest rates, greater negotiating power, access to better housing, and most importantly, the freedom to make financial decisions from a position of strength rather than desperation. Once your score reaches a genuinely strong range, the conversation shifts entirely. It stops being about fixing damage and starts being about leveraging trust, using favorable interest rates to acquire appreciating assets, using approved credit lines strategically rather than out of necessity. This is the real definition of financial freedom, hiding behind this number the entire time. Not simply the absence of debt, but complete control over how credit gets used, rather than being controlled by it. None of this work should happen in isolation from the rest of your financial life, because a rising score paired with an empty savings account still leaves you fragile. While disputing errors, lowering utilization, and building history, it helps enormously to simultaneously build even a small emergency reserve, A few $100s set aside specifically so an unexpected expense never forces you back onto a credit card at the exact moment you are trying to reduce your reliance on one. These two goals reinforce each other directly, because a healthier score eventually earns you access to better financial products, while a small cushion of savings protects the progress you are making from being undone by a single unlucky month. Treating credit repair and saving as two separate, unrelated projects is a mistake almost everyone makes, when in reality they are two arms of the exact same goal: financial stability that no longer depends on borrowed money to survive an ordinary surprise. There is one final shift worth making explicit because it separates people who merely fix their credit from people who use it as a genuine wealth-building tool. A strong score is not the finish line. It is a key that unlocks the next stage of financial growth. Real estate investors use excellent credit to secure favorable financing on properties that generate income for decades. Entrepreneurs use it to access lower-cost business credit rather than expensive alternative lending that quietly erodes profit margins. Even everyday consumers use it to negotiate better terms on nearly every recurring financial product they hold, from insurance to banking fees. The number stops being a source of anxiety and becomes instead a quiet form of leverage, working in the background of every major financial decision made from that point forward, exactly the way it once worked silently against you before you understood any of this. Every single decision covered here, from paying a bill 3 days early, to keeping an old card open, to disputing a single incorrect line on a report, adds up into a financial reputation that follows you for decades. That reputation is either quietly working against you, taxing every loan, every rental, every opportunity connected to trust, or it is quietly working for you, opening doors that remain closed to people who never bothered to understand this system. The version of you a year from now, applying for a loan, signing a lease, or negotiating a rate, will either thank the version of you watching this right now for finally taking this number seriously, or quietly pay the price for continuing to ignore it. Finally, understand this. Your credit score was never really about a number on a screen. It was always about the story your financial behavior tells before you ever get the chance to explain yourself.